Ladies and gentlemen, welcome to this wrap-up keynote address for this edition of MIPIM 2011. The principle for the address is very simple. I'm sharing the stage here with Philippe Tannenbaum, who is a senior advisor at IEIF in Paris. The idea is to share with you his insights from his research about the markets today and where we are going forward. And then the insights that my students and I from the Wisconsin School of Business gathered from you, the participants, from you who were on the booth, from you who were walking around, and you who spoke in the conferences. So without further ado, I'll let Philippe start with his own insights. Just one little thing, please turn your Blackberries and cell phone and iPhones off because they interfere with our microphones. Thank you.
Yeah.
Philippe.
I forgot to do it with mine.
Wait. Thank you.
As an observer, I would say that at the moment, the key words for the market to describe the market are probably risk aversion. Risk aversion at a peak. Of course, at the MIPIM, you know, while going through the different places of the MIPIM, we could notice that there was some rising optimism in the MIPIM. But there is still that risk aversion, which is still a driver of the market at the moment, with four main consequences, as you may see. And these are the four consequences that I will develop during my speech. First, we're having at the moment a two-tier market. I'm not sure investors have understood which are the risks which are included in a two-tier market. I will come back on this a little bit later. Secondly, financing is still very difficult and might probably become more difficult still because of that risk aversion. Third, well, all investors are looking for the lowest volatilities at the moment. We'll come back from this. And fourth, due to that increase in risk consciousness, I would say that regulations are being regularly reinforced. And at the moment, we might consider that regulation is becoming not a help, but a threat for us. So back to the two-tier market. As you may see it, uncertainty about the economy, a high aversion to the risk. Everybody could notice that there is a recovery, definitely, but the recovery has focused on the prime segment solely. For example, our friends of IPD give a good indication of what is a secondary segment, you know, with prices, which is very interesting because, for example, in France, we define the secondary products as everything which is not prime. This is a definition. Well, they say secondary, they give a good definition of a secondary market, and they could notice that prices in the secondary market are still 48% below peak levels, while prices in the prime markets, you may know it, you may be aware of this, in London are very close to the prices of the peak levels. This is true for all the markets, not only for the UK, this is true for the US, this is true for the UK as well, and this is true for France too. Oh, sorry. This is true for France too, where we have got another measure, you know, due to the fact that we are less accurate in our definitions. We use another measure, which is the measure based on the prices of the stock on the market. We do consider that the stock markets are a good indication of what are the prices on the market itself. And we could notice that we had a sharp recovery on the stock market, of course, but you may notice that it's mainly, you know, big caps, it's mainly pure plays, and it's mainly shopping centers which benefited from that recovery. While, for example, you may see the last line, you know, all which is a local mix, I would say, places which are not of very high quality, which are everywhere in France and not only in the CBD. That chart, you know, it's the last chart. It's in orange, I guess. You may see that it didn't perform exactly the same way. What the markets tell us is that definitely they do believe in a recovery. You may see it in the charts, but they do consider that recovery has got to be limited to the prime segment.
And maybe to clarify on the scale, it starts from 2002 with the peak at 2006. The bottom is hit on December 2008. and the recovery, the latest data is September 2010. It's a very different experience for the residential sector in orange.
Now the point is, okay, we are having a two-tier market. Now the point is, how sustainable can a two-tier market be? Now it's something to say, well, okay, we have a recovery which is limited to the prime segment, and forget about the secondary segment. No, we cannot forget about the secondary segment. Just for there is one reason for this. It's that the market is a place of unicity. You know, you may not have a part of the market doing well, another part of the market not doing well. A market is a united place. You know, you may see it. What may be the consequences of the two-tier market? First of all, banks might decide to halt financing and especially refinancing the secondary assets. You know, well, RBS has already said that they will not refinance the loans on that part of the market. So also they might decide to sell their holdings on that part of the market in order to crystallize the losses. So new sales on one side and a lack of buyers on the other side, because investors obviously are not interested in secondary assets, and there is a lack of financing also for those assets. So new sales, a lack of buyers. This indicates that secondary property valuations might fall further, and this indicates that the crisis might not be over for that type of assets. So what are the consequences of this? First of all, there might be new covenant breaches and new investors being in a bad situation in front of their banks. Second, for all those secondary assets included in the funds, for example, or in the investors' portfolios, there might be new losses, and why not imagine that there might be new redemptions from the stockholders, from the shareholders of those funds, you know. New redemptions, so you have got to find the money, the funds will have to find the money, funds might have to sell the assets, some new assets, some additional assets, in order to feed the redemptions. And which kind of assets are they going to sell? Of course, prime assets, you know. And that means that the situation of prime assets is maybe not as secure as we may believe. The fall in the prices in the secondary segment might diffuse to the prime segment.
So it's a contagion argument because those assets are held in the same portfolios.
Yes.
Yes. And if one goes down, it's going to drag the other one down due to financing constraints.
Exactly. Of course, take it as a worst-case scenario. Take it this way. But it is a scenario, you know. I just want to underline that you cannot have a two-tier market, and a two-tier market might lead to a two-step crisis. Might. Second, as I mentioned, remember, risk aversion, so two-tier market. Second consequence, financing more difficult. It's not that much from the bank side that problems are coming. It's more from the vanishing of securitization. As you may see, securitization and private equity in the past have taken the place of the bank, you know. And it's the vanishing of the private equity which might create the problem. So the good news now, is that everybody predicts a comeback of the private financing, you know. You may see this comes from Prequin. Recent launchings show a renewed interest from the private financing, and mainly through mezzanine or preferred equity. It's the same thing, more or less the same product, in order to finance the market. So that's the good news. The bad news is that I don't think it's realistic to think that mezzanine would take the place of the bank. And I don't think it's realistic to think that mezzanine will be sufficiently in the market in order to finance it significantly. Why? Well, because mezzanine is risky. It's a risky financing. The mezzanine lender does not have the same access to the cash flows and to the guarantees provided by the assets, which means that they will ask for a higher yield. You know, of course, the minimum yield for mezzanine at the moment, remember that the minimum yield for a loan, a banking loan, is around 4%, I would say, let's say 4 or 5, I don't know exactly. The minimum yield for mezzanine lending is 8%. That means those lenders are going to require an 8% yield on prime assets. Do remember that we are having a two-tier market, and they will only accept to finance prime assets. So 8% on prime assets This is not realistic. Third consequence, well, looking for lower volatilities, of course. High profitability means high volatility. We can notice it on all markets, on the French market, of course, on the UK markets, you know. This is the place where you make money when you have got volatility. Risk adversity means looking for lower volatilities. You want to be sure of your money, you know. You don't want to take the risk of seeing your money divided by 2 or sometimes 3, you know, to see 80% of your money disappear. So looking for lower volatilities, you must accept the idea that when you are an investor, lower volatility means lower profitability. So the products do exist. But the issue is, are investors prepared to enter those new territories, those new cases, you know, low volatilities, of course, low risk, but lower profitability? Are they prepared to accept this? Just look at this. This is a Switzerland illustration, you know, a very nice place. I've got a little house in Switzerland, you know, which my mother-in-law bought 20 years ago. I wanted to sell it 1 year ago, and the price where I could sell it was exactly the same price, the price at which my mother-in-law bought it, you know, which was an excellent occasion for me to tell her that she was totally, well, forget about it. But she was off the market, that's all.
You chose the wife.
Look at this. See, this is quite interesting, you know. The Switzerland model, there is a model. We may speak of a model, of something which is coherent, you know, which has got its own currents. The Swiss model is a model based on stability. They don't want to make money. They want to be sure that at the moment where they're going to liquidate the pension, they will find back their money. They don't want to perform. They want stability. And you may see that, for example, they had in 2008 and 2009 an excellent occasion to make money. It's a time when the government bonds declined very significantly. You know, even during the whole period, you know, from 2000 to 2009, you know, there was a permanent decline in the long-term yields, long-term rates. So this was an excellent occasion to let the prime office yield, I mean the yields, the property yields from a general point of view, to let them decline also, you know. And you can see they didn't do it. They kept the same cap rate during the whole time, you know, more or less 20 BP, you know. They kept the same cap rate because they didn't want to make money. They want stability.
So this is here a preferred habitat argument. That
yes.
The big point here is that the difference between the orange line and the green line has been moving over time, and the orange line just stayed flat, right?
Very flat.
People just like that.
Not only did it not decline, yes, that's true. Not only did it not decline, but it remained flat, you know. Yeah. Another illustration is on the German housing side, you know. If you look at what happened in 2003, the index was 100, you know, and look at what's happening now. That is 12 years later, the index is 107. You know, prices remain quasi-stable. You know, 7% increase in prices, but also, you know, quasi-no volatility. That's very interesting because this indicates that when you chase performance. For example, when you are an opportunistic fund, do not enter the German market. Remember, some 6 or 7 years ago, remember some funds which are very opportunistic, they wanted to enter the German market. This was probably a mistake, you know. When you're chasing performance, you don't enter the German market. It's when you're chasing stability that you do enter the German market.
And here for housing, I know this better than the commercial real estate side, is they also have a policy of supply. That really target that flat rate. And it's a country, you might know Germany, with a much lower home ownership rate than places like France or the UK or the US. And therefore, citizens have a very different attitude to housing returns. If you own a lot of housing, your tendency or your willingness to vote against housing supply is very strong because you want to protect your value. Germany is quite different. And they have an interesting mechanism to spread the gains from rezoning. And it shows up in this very stable housing price.
Definitely. They do fabricate stability, you know. Mm-hmm. This is more or less the case, more or less the same story for German commercial property. You may see prime yield offices, you know, they didn't move, you know. They didn't move during the whole time, you know. Very stable. So, are investors prepared to that new approach, you know? Again, I say it, low volatility, that means low performance. Are investors prepared to this? Well, let's just have a look at what is taking place in France at the moment. France has got more or less the same product, you know, with our housing sector. You may see we have got an index of prices in the resi sector. We have got many prices index in France, but the IEIF has made a special effort in order to calculate a reliable index, you know. For different reasons, all indexes are not as reliable as we could wish, and we consider our index is the most reliable one. You may see that the housing sector is very stable, you know, and for fundamental reasons, you know, demographic reasons, to say the word, you know, it's up-oriented. I mean, we are not looking for performance, but we are making performance on that side. But the most important is to see that this is very stable. You know, you see the volatility is very, very low. However, there are no private investors in the sector. By example, there is only one housing REIT in France. In France, we have got the French REITs are called SIC, you know. It's exactly the same thing than a REIT. It's an imitation of the REIT status. We are only having one housing REIT. Well, we could have tens of them, you know, due to the size of the sector. And it's a shame because you may be aware that the US housing REITs in 2010 was the top performance of the market. You know, they increased 47%, which means that you do not need to make a renunciation to the performance when you're looking to volatility, to stability, you know. But you need to be prepared to have no performance. That's the point, you know. And you may see it in France, for example. We're not prepared for this at the moment.
Now, you might not see, I think, on this screen as well as we see it here, that the transaction data has been dropping quite a bit at the time when the prices have just gone up. And if you look at experiences of countries like the UK and the US, it's often not a good sign. Transaction going down tends to precede prices going down. So maybe we can revisit this next year and see what happened with the performance.
Prices might go down a little bit, especially due to the rate increase and so on, and to the vanishing of the demand. But you may see that on the long term, the trend is still very, very stable. You know? That's the point, you know. We might have a little decline in the coming year, but I hope we see you next year. Last consequences, last but not least, unfortunately, the regulatory side. At the moment, you know, it's becoming very heavy, very, very heavy, you know, because, well, all authorities, you know, all people who are in charge of the market are aware that they didn't do their job correctly, you know, in the past, we may say so, and now they are overreacting. Definitely, overreacting. Look at this. Insurance company solvability. This is Solvency II. Basel III, bank solvability. So insurance banks, all main investors are going to be touched by this. Of course, hedge funds are going to be touched. Derivative markets are going to be touched. And all funds through the UCITS, you know. And also, we're going to have green paper and pension system. Which means, and all this coming into effect very quickly, you know, very rapidly, you know. They are really, I heard a conference by Mr. McCreevy, and he said, we won't go back, you know, be aware that we won't go back, you know. So that means that all aspects of the activity are going to be regulated, and by very heavy regulation at the moment, you know. And that's quite, well, it's a threat, you know. Just to remind you what's behind the regulation, they say they measure the risk, they are able to measure the risk through the volatility. They measure it asset class by asset class, you know. What's the risk which is linked to a stock market? What is the risk which is linked to property? What is the risk which is linked to the funds? What is the risk, and so on, you know. And for each asset class, they translate the risk into capital requirements, which are supposed to be proportional to the risk, you know. So the higher the risk, the highest capital requirement. Also, there is a second aspect which is very heavy, which is that there are disclosure and transparency requirements. So the good news, again, you see the market is not white or black, you know, it's green, but due to very low volatility, direct property, because we are having volatility, but our volatility on the markets, on the property side, is much lower than the volatility on the stock markets, for example. So, due to that low volatility, direct property will be favored by, for insurance companies, as well as mortgage loans, which are supposed to be to have a very good guarantee for banks. So those assets will have to bear lower capital requirements. Nevertheless, Mr. McCreevy is very clear that for the secondary property market, remember what we said a little bit sooner, and you're having another illustration of the fact that that two-tier market is a tricky thing. For secondary property, there might be heavier capital requirements, which could accelerate the disaffection for that part of the property sector and the movement of freeing up the balance sheets. And remember, we have identified the fact that it could be a threat for prime assets also. Remember this.
So this is another drawback that you point out of holding diversified portfolios across the first tier and the second tier market. Yes, yes. First was through financing contagion, now it's regulatory contagion.
Yes, exactly. This is a second aspect of the same thing, absolutely. For indirect property, I'm talking of the funds. The fund status, to be honest, is not yet very clear. There is that idea of look-through, you know, which is not very clear, at least in my mind. You know, I mean, I still don't understand it. So maybe the problem is not with the status, is with me. But at the moment, I'm not able to understand it.
You should ask your mother-in-law. She can help you with that.
The point is there is another aspect that the listed property sector will be treated as a part of the stock market, not as a part of the property sector. The stock market is supposed to be the most volatile. And this could lead to reduction in the insurance companies' holdings. You know, we have calculated at the IEIF that 1/10 of the market, which is at the moment located in the portfolios of insurance companies, could have to come back to the market. So 1/10 is not significant, but this could cap the market prices, you know, on the market. And we may see it already at the moment. You know, we are not doing as well as we used to do before, you know. Also, another consequence I wish to draw your attention about this is that due to the new reporting requirements, all actors will have to bear very heavy additional costs. You know, reporting and financial communication is going to be very, very heavy in the coming years and cost masses of money. You know? Well, just to terminate with this, just two slides. To have a view of the bigger picture, not only the market, but the bigger picture. As we mentioned it many times during that MIPIM, you know, the public debt remains too high, too heavy in all advanced countries. You know, you're having the figures, you know, some worst case scenarios show that in some countries the debt could represent something like 150% of the GDP, which is simply not manageable, you know. So we're having two solutions at the moment: repayment, a very heavy burden leading to recession, as we are seeing, for example, I hope we won't see it, but as we might see in the UK or in Greece, in places like this, you know, and you may be aware that deflation, and this might lead to deflation due to the lack of cash, and you may be aware that deflation is a worst case scenario for real estate, you know, because in a deflation period, assets have got no value. The only asset which has got a value is the cash, because this is a rare asset, you know. On the other hand, this could also lead to inflation, I know it's not very politically correct to say this, but I hope that we will have some inflation, because inflation is real estate friendly. But of course, I'm not supposed to say it. So, as the outlook, you know, let's sum it up, which is the case for a positive outlook. Recovery in the prime, and we are having two cases, you may see it, positive outlook, and I would say less positive outlook. Positive, recovery in the price segment, that's obvious. Less positive, as we mentioned it, recovery only in the price segment, and the two-tier market is a threat for the market as a whole. Positive, private finance seems to be back. Less positive, I don't believe in it. Positive, secure products are available, as we saw. Less positive, where are the takers for those products? Positive, regulation is good for property, we saw it, but negative, it will be bad for indirect property, definitely. And indirect property is a good way to access property, is one of the main ways to access property. Positive, we might have some inflation. Negative, we might have some deflation. So you see the balance. And last, you know, the judge of peace. I'd like to have to draw my conclusion from this. This is a VIX index, which is an index of volatility of the market, which is an index of stress of the market. This index is made by the Chicago board. It simply indicates how stressed the investors are, which means how confident they are on the future. And you may see, for example, the Lehman period, you know, in the Lehman time, the stress was at a peak, you know, remember it, November 2006, I was on the markets in London at the moment, I remember it was not a nice time. Look at look at the range where we are trading at the moment, you know, this seems to indicate that despite the problem with the public debt, people seem to be very confident for the future. So this is a good indication, and I'm happy to terminate on this.
Thank you very much, Philippe. So now for the second part of this presentation. It's my duty now, my responsibility to share with you what we feel you told us, what we feel you experienced. And so the way we proceeded, we had 11 students and a colleague of mine from the Wisconsin School of Business. We attended every single conference. The MIPIM organizers were nice enough to let us attend a number of private and closed events. We attended a number of customer conferences. We surveyed people in the booth yesterday, people who are walking around, and we had our own conversations. And so what I'm going to tell you now is to try to wrap up what we heard from you and get a sense of the buzz of the market. But before I get going, let me remind you just the key elements from last year's keynote. Same effort last year, just different students. From the investor side, there was very much a return to focusing on the real estate, this working above the NOI line, working on the cash flows, what brings the value to the property. And there was a lot of talk about how, in particular in the fund world, we need to be more transparent to our investor. And you know, you talked about increasing reporting requirements coming from the regulatory side, but also coming from the market side, just wanting to know more what is going on with my money. From the cities and regions, last year there was looking for optimism to looking for a new reality, coming out in particular from that sustainability concern and understanding that sustainability is a lot more than CO2 emissions. It's about having better urban environment for better living conditions. And a clear sense that this idea, public-private partnership, had to be experimented with. It's no longer a dirty word in the language of the cities and regions officials. And so really our conclusion last year was that we could see the sun rising, and we were hopeful that the sun will continue to go up and shine on our industry. And so what about this year? Well, we asked you first, how is your business activity this quarter compared to the same quarter? So we'll divide our survey in two pools of participants, the cities and regions, so if you want public employees, and then others think of it as a private sector, investors, service providers, and you know who you are. And the basic message here is that for 2/3 of the people, business is better this year than it was last year. In every survey of this type that we do, is unfortunate, there's always 2 or 3 people who are just having a bad time. But for most people, you know, life is good and life is getting better. And we ask how weather and how MIPIM changed their outlook. And it's actually encouraging to see that the people in the cities and the regions experienced a stronger burst of optimism from their presence here. And that comes from who they see coming through the booth, and that comes from all of you investors. I'm sure you realize, and you know this, is nothing you can do to make someone happier as an investor or as developer is to stop by a city booth and ask about what do they need as further investment in their locality. So the cities had a good experience, but overall is about, if you average it up, about 40% come out of MIPIM happier than they came in. Then we asked them about their perspective on their real estate market. So this is trying to think forward compared to the same time last year. And this optimism from MIPIM translating more optimism overall going forward about their own market. And that's what you alluded to. We live in a world with a lot of risk. We live in a world where we know there are dark clouds. But overall, you know, 2/3 of the people who were here came here on an optimistic note, or at least are living on an optimistic note. So we heard it from Philippe, we heard it from you very much so during these past few days. We were talking last year about the sun rising and hoping it would rise, and it's basically already high noon in the core market. And I want to emphasize the word already. Just a number of you talked about the surprising speed of the cycle, the surprising speed at which we went from bottom to up. You know, there was a very fast correction in the UK, then it went up right away, and then maybe into the US, maybe in France. And this is about chasing safety, this is about chasing yield from not just core asset, but core plus, core safe assets. The key cities, the key investment, I'm not so sure actually whether it's UK, US, France, or whether it's not just really Washington, DC, New York City, and London and Paris, what your capital analytics called the Fab Four. And really, when you look at these cities, you wonder whether they are really bets on the national economies, or whether they are actually bets, Washington, D.C., on the strength of the US federal government, and New York City, London, and Paris, these are bets on the strength of the global economy, and some of it is bets on the outflow of capital from certain regions which are in troubles around the world, and where that money is pouring into places like London, Paris, and New York City. The new thing we heard this year that we hadn't heard at all last year is this moving to Germany. Moving to Germany for the strong history of yield. And if you're curious and you want to find out more, get that slide from IPD of the history of yield and growth from Germany, and you'll see it's an amazingly track record of delivering stable yield, very similar to the picture Philippe showed for Switzerland. Very, very similar, even on a longer historical scale. Now it's high noon on the core market. You might actually wonder, the sun has come up, are we already on the way down? There's certainly a lot of concerns during the MIPIM. There were transactions taking place in the world at the sub-5 cap rate and at the 4.25 and the 4.5 cap rates. And you might remember that in 2009, there were people here talking about the craziness of those sub-5 cap rates during the boom of 06 and 07, and that craziness just somehow that memory is just lost really fast. Now, at the same time, I talked about the flowing to Germany, and there is very strong evidence of a strong history of German yield. Yes, they have been flat and stable for a very long time, but over that same period, Germany has never experienced growth in real terms. Yeah, and most investors are worried not just about yield, but care about the total return, which is, as you know, yield plus growth. So there is a sense of a bit of wariness from what I might call these macro or momentum strategies, just, you know, this wall of money, just hunting in parks on these safe, high yield type of properties. But at the same time, we must be realistic. There's a number of you investors who have to deploy capital. And so really, this is not, I think, a reason for cynicism about the industry or for cynicism about the lack of memory. It's just recognizing the investment environment with very few opportunities out there to place capital to get yield in an environment where investors are asking for yield. And that really is what we are witnessing. So to go to this broader picture, you all know that Rubini gave this keynote address here, and is probably among professors' colleagues, I had never seen someone deliver presentations with 5 points plus 5, with one of them and 5 of them in it, without any slides. And so I cannot repeat his performance, so I wrote down his points. He had this half full and half empty picture. And so to remind you, the half full, it was about the accelerating global economic recovery. It's about, you know, decreasing risk of low tail events, this major shock, deflation, double-dip recession in the US and other mature economies, lower risk of a breakup of the European Monetary Union, very strong corporate performance, in particular in mature markets. At the same time, growing emerging economies. And that's important because it provides diversification to the sources and the engines of growth in our world economy. We're not just all now dependent anymore on the US consumer. And then a sense that in a lot of economies, the worst of the real estate and housing bust is over. I mean, that in some economies it's more wishful thinking to say that than it is in other, but maybe at least hoping that we're getting there. And as Philippe mentioned, you know, risk is on and risk aversion is maybe a bit lower now. That was the half-full part of the presentation. There was a half-empty part of the presentation. And just to make sure we leave the room in a happy note, I actually cut down 2 of the bullet points. But, you know, this painful deleveraging of the mature markets. There's still a lot of debt out there in the public sector, like Philippe mentioned, but also in the private sector. And there's still a lot of work that needs to be done. There are high and rising budget deficits. Very serious chronic problems in the Eurozone periphery. And it's not clear we figured out how we're going to agree on how we solve this. The risk of a double dip in the US does remain. You know about inflation, particularly in the emerging world, and the effects it has in terms of political risk, right? I mean, I don't have to tell you about the North Africa and Middle East turmoil. And then this citation, word for word from Rubini, you know, are we really in a G20 world, or given the lack of coordination we observe, isn't it more a G0 world? So that's what his view was on the macro picture. We also ask you what your point of view was. In particular, we ask you what were the risks that you are most worried about. And obviously, real estate debt market is in the background of everyone's mind, although it was not as talked about as it was last year. Really, one thing that was new that we hadn't heard at MIPIM before was the sense of political risk in mature economies. You know, we are in uncharted territories in many countries in terms of fiscal and monetary policy. We have engaged ourselves into programs on both the fiscal and the monetary side that we have never done before. And it's not clear that anyone knows and understands the optimal exit strategy and the consequences we're going to suffer. Philippe mentioned the regulatory risk. Lots of worry about that. Let me add an extra point we heard that I found quite interesting. If you need to raise taxes, everybody pays income, everybody pays consumption tax because everybody consumes. Everybody has a house, so residential property tax touches everyone. But there's a kind of tax that's very convenient because there are not that many voters that own that property type directly, and that's commercial real estate. And I know that is a concern in particular in a country like the US, where we have a strong property tax as a resource for the local communities, and the local communities are suffering from lack of transfer from the state and from the federal government. And then this inflation risk, that we can look at it as positive or as negative. I think, at the very least, another driver of this chase for yield, because we want and we hope that commercial property would be a good hedge if these risks were to materialize. So within this environment, this half-empty, half-full environment with the risks that we see on the horizon, the sun shining bright on the core markets, what are the strategies that we found most interesting for today? And first, I have to talk about the emerging markets. Very strong continued growth in appetite for Asia on the part of investors. And at the same time, what I find most interesting is a growing awareness of the diversity of Asia. And that's actually, for those of you who are at MIPIM Asia, you'll know this is very much in sync with their view from Asia about what's happening in their own economies. And you will find this in the data with a growing amount of within the region, so inter-country capital flows, not just growing amount of capital flows from here to there. And this is their view being that there's a lot more to Asia than the Hong Kong and Shanghai and Beijing's of the world. And I would notice that actually this year at MIPIM, there was a delegation from Chongqing. Now, it's hard to argue with Chongqing as a second-tier city. It's more than 30 million people. But it's interesting that they thought to come here and show up and interact with us. Now, there are many markets beyond the BRICS at MIPIM, and I don't have the official statistics, but there was a number of markets I'd never seen here before, including North African countries. I can tell you that there was only one cancellation from that region, but there was also Rwanda and Kenya and Mozambique making the case for investments in their country, and some pretty sizable investment here. And remember the survey, those people in the cities and regions, they are living happy with their experience at MIPIM. So we actually asked you, we didn't ask the cities and the regions that question, we asked everyone else, those of you working in the private sector, what are the countries that you would consider first for investment if you were to look only at the emerging market? And you see a familiar ranking of China, Brazil, and India, up front. It's interesting that India actually wasn't here, and maybe we should let them know there are people here that are interested and they might want to show up. You know that Turkey sponsored that reception on the first night, and it's interesting to see they show up in the fourth position. And then I'll let you read the graph. Interestingly, Vietnam showing up. Vietnam has also started to show up in a U.S. investors survey as a country that's a destination for diversification within Asia. Even if it's a somewhat small country, it's interesting that we see that name popping up again and again in those investor surveys that we do at my school. So strategy for today is emerging markets. Obviously, they are the strong fundamental stories, and these are the stories we heard about on the booth, but you all know about the country risks, political risks and economic risks. And that really is a trade-off on those countries. What kind of risk and what kind of price premium or return premium do I need given the risk I'll face if I get in there? Now, beyond those emerging market strategies, we heard about people interested in moving to beyond the core toward maybe more opportunistic strategy. And so the way we would characterize what we heard is core plus 200 to 250 basis points. And so to give you an image of what that means instead of investing in German retail, maybe I'll invest in Polish retail. So that's the type of strategies we are talking about. Now, we actually ask, let me tell you before I show you the graph, there was a leaders' breakfast organized with Noria Rubini yesterday morning. And so we had about 60 leaders of the industry present in the room, the CEOs and the chief investment officers. And so we asked them from their point of view, how many of them thought if we were to give them more money, were they willing to invest in this core plus 200 to 250 basis point? And their answer actually was only 15%, 1-5. Thought this was the time to move to the core plus. But these people don't spend time on the floor and in the booth, and maybe they should, because they will realize there's a bit of a discrepancy between their view of the world and the view of the people we met on the booth and on the floor, where actually 70% of you, and again, we did not ask this question to the cities and regions, we only asked those of you involved in the private market, 70% of you thought it is really the time to move beyond core and look at core plus or value add strategies. So that's a source of optimism. Maybe that's going to pick us, that second tier market is going to come up and resolve your arbitrage concerns. Yeah, let's cross our fingers. Another strategy we heard that I found quite interesting within the mature markets from people who are active and even doing development activity is taking advantage of the functional obsolescence of the existing stock. And maybe this increasingly fast functional obsolescence. So coming from two sources. The obvious one, which has been an ongoing theme at MIPIM for more than a year now, is, as you know, this greening of real estate, which goes beyond green with very fast technological progress leading to lower costs. We had a developer telling us that over the past 2 years, he felt the green component of his construction cost went down from 8% of the cost to 2% of the cost. So very fast technological progress. We also heard a number of developers invest telling us it really is no longer an option, even if you are hesitating as to whether it makes sense today to build a greener building versus not. If you think about your investment and the exit strategy for your investment 10 years down the line, can you afford today to build a property which will not be a green property when you try to sell it 10 years down the line? And the penalty there is so big that even if today you are hesitating, that exit strategy concern is going to drive the day and makes the decision a no-brainer. Now, at the same time, we had really strong dissatisfaction with the way the green standards are being handled right now around our economies. That's just because there are too many of them, they don't agree with each other. Some people express views it might be a rip-off from all these certification agencies that all want to be paid to make sure they measure things. The inconsistency of the measurement and also the really, I think part of it, one could be cynic about those complaints, but I think some real complaints, for example, about why should we measure how green a building is by the square foot rather than by the usage, right? Airplane CO2 emissions are not measured by square footage of the airplane, right? They are measured by seats. Right? And you know that part of a green building, or you can make a huge difference by planning the usage of the building. It's not just about the overall size of the building. And then we also heard about if no longer maybe a green premium, but a brown discount, right? That the buildings would just not being built properly, getting a discount or maybe becoming the first one to be vacant. And then I think behind this green social responsibility type concerns, there's a next wave that's coming, that's accelerating functional obsolescence. And I would characterize as this what's happened when the human resource department and the human resources people are talking to the corporate real estate people. There are fantastic advances being realized in space that's flexible, that can be reshaped. The idea that you build an office tower with different sizes so that the most senior person can have the biggest office and the most junior person can have an office that is smaller, that is over. There are lots of companies that are understanding that people need different types of spaces for different types of duties and work and responsibilities. They need break space, they need quiet space, they need meeting space for fast meetings, for long and concentrated meetings. And those buildings that have this flexibility to rearrange the space or that are built with this in mind, this new human resource corporate real estate intersection in mind, there will be the buildings where it's easier to hire those young generation, where it's easier to retain them. And if you look at the retention cost versus the cost of a cheap rent versus a good rent in a brand new building well designed, you'll see that it's actually worth going in a brand new building. And so, and that might take a while to work its way through the industry and affect the rents, but prices should reflect that very quickly. So that's a trend I would watch for. And I find it quite exciting because this is the developers in the private sector working with the architect to make our place of work more friendly, make us more productive, and makes us happier. And now, this gets even better because when you meet with the cities and regions here, you get a sense that not only those architects and design and developers are working to make our place of work and our place of life better, everyone is interested in making the space around our place of work and place of life also an appealing space. So it's very, very interesting and entertaining keynote from Boris Johnson, the Mayor of London, who argued that cities are the single most brilliant invention of our species. And this actually is data that is supported by a recent book published in the US by Ed Glazer, The Triumph of the City, that people live longer in the cities, they have better educational outcome, they have better productivity, they are less pollution per capita, and I think the last one, Boris added it to the book, it's a greater opportunities for reproduction. Now, what was interesting is he mixed that with Gandhi's perspective that the village is what matters. And in his view, and if you've been in London, you'll see that it does make sense with what London is doing, is that the secret to the success of the city is to keep the village back in the city. And by that he meant the sense of trust among the citizens, and then this new word I learned, the neighborliness of the city. And it is a proper word. So what's driving this? What's driving this is what drove him to be here and entertain and well prepared. Is a very fierce competition across cities to attract population, to attract economic activity, to attract national public investment, and then to also attract public investment. And this has now become a global marketplace. So the city of Nottingham, to not pick on anyone in particular, announced they were getting funding from China and from Abu Dhabi, right, in Nottingham. Great for them. We did ask the cities and the regions, what do they consider the biggest impediment to investment in their location? And you see, global economic conditions is a winning factor, so they are suffering from the recession like the private sector. But then the second factor is competition from other cities, then local economic fundamentals, and then the political climate. And so we asked them, in this context, when you are fighting with each other in this fierce competition to attract investment economic activity, what did you do to put yourself forward? Yeah, so what competitive advantage did you emphasize in your presentation to investors here at MIPIM? And location, growth, but also this regeneration, new visions, and for a few of them, the high-tech base and the infrastructure development. But definitely location growth as the key factors being put forward to attract investment and economic activity. So moving forward, there's a clear sense that from the point of view of the cities and the regions requires new strategies, at the very least because the fiscal resources that used to be there are just not there anymore. And nobody wants to be a city leader doing nothing for their citizens. So what we see is a greater amount of cooperation with nearby cities. It's quite interesting as you walk through the floor that you see some cities that might have a different booth, having the booth together, or cities that used to not be there, be part of the booth of the nearby agglomeration, right? And the sense there is that if we want to compete against the large metro areas, those big international, the Londons and the Paris in Europe, we have to get together. beyond the competition driving this agglomeration, this cooperation, also the fact that in a number of countries, access to national investment, to funds from the national government requires cooperation, or you get a better chance to get that railroad line or that grant from national government if you are aligned with each other. And then most interesting, there were a number of projects here of cities reaching across borders. So Strasbourg connecting with Kerl, or Malmö and Copenhagen. So very interesting that they are able to get beyond national constraints to just find a way to compete with the Londons and the Parises. So we also see new strategies in policy making and the regulatory process, and there I was most fortunate to participate in this MIPIM mayor think tank. So it's a closed event with just mayors, deputy mayors, and the people in charge of urban planning. And then you had the mayor of Kigali in Rwanda exchanging business cards with the mayor from Copenhagen, and the deputy mayor from Moscow, and the mayor from Sao Paulo, and the urban minister from Montenegro. What were they exchanging business cards? Because they had exchanged ideas about infrastructure, and they were understanding that each one of them had a different approach due to their different environment, and there were ideas to be gained. Now, the kind of ideas that I found most interesting from that think tank is a number of innovations around the world to capture the windfall profits from public investment and zoning changes. And I believe we are about to witness a fundamental change in what it means to be a successful developer. So to be a bit cynical, the idea that a successful developer is the one who buys a land and then pushes the policy process in a way that gets his land rezoned with increased density and capture that capital gain, that is over. That is over because the cities don't have a choice. Now, in a number of mature markets, the innovations cannot come in because of legal requirement and constitutional issues, but I'll just cite the case of Sao Paulo, where they commit by law to a certain increase in density and infrastructure expenditures, and then they auction off the building permits at the stock market, and then there's a secondary market for those. And then they take the cash from this auction and they use that to build the infrastructure. Well, if auctions work the way we economics professors teach them, that's a perfect way to capture what used to be the profits from windfall of pushing your way around the political process to get your increase in density. And it's not just there. There were innovations in Kenya, there were innovations in Copenhagen, and they were all sharing a lot on those kind of ideas. So maybe a change in the way developers work. And that leads to me to try to conclude with going back to the title of the presentation, what have we learned, what next? And I think this leads right away into my first lesson, I think, that we heard loud and clear with our students at this MIPIM is transparency. The value of transparency. I told you last year we had heard about increased requirement for transparency coming from the investors on their investment advisors and the funds. This is transparency to a whole new level. So what do I mean by this? We see transparency reaching further because people realize you just can't afford to be sloppy and non-performant. You need to learn from each other. There were cities talking about how they benchmark each other. The mayor of Ljubljana, at the end of the year, conducts a cell phone survey from 1,500 people. His pay depends on the approval rating that he gets in response to a cell phone survey. If it's less than 50%, he gets no pay. Yeah? So that's the kind of transparency we're talking about. And by the way, he was explaining this to the other mayors around his table. There was also a very interesting discussion about the fact that if you are from a country or a city which has a very strong history of corruption, actually you have no choice but being transparent because you have no resources, you need to bring investment. And the only way you're going to bring investment is by being transparent and saying, I've changed, and to prove to you I've changed, here is everything I'm doing. Now, this transparency is being supported in a way we find quite interesting by the increased availability of data. And there are very interesting partnerships between private providers working with public authorities. And Philippe talked about IPD and Real Capital Analytics, as I'm sure other firms on the floor here were showing how they're able to expand the type of data services that was available before only in mature markets to emerging economies. And also, interestingly here, we heard from Rix and the US Councils of Real Estate, this expansion of the professional accreditation organizations. Right? These are organizations which have this transparency and social responsibility dear at heart. So big increase in transparency, not just in the private sector, but in the public sector. And from there, what you get is a sense that we need to rethink what leadership means. Leadership in the private sector, leadership in the public sector. First and foremost, leadership is about long-term thinking. And that's the developers and the investors paying more attention to the smart building designs, and maybe because they are socially motivated, but also simply for the bottom line, what I mentioned earlier, this exit strategy. How is your building going to be positioned in the urban environment 10 years from now, right? Can you afford to not be at the edge of sustainability? And then from the city and regions, the idea that you need smart communities to maintain the attractiveness and the vibrancy of the urban environment, because the competition is fierce to attract economic activity across population, because we have all become so mobile. Now, this long-term thinking is not necessarily easy. It requires educating the clients, educating the partner. The missing elephant in the room at the mayor's think tank was the national governments. There's so many complaints about the regulations that cities faces, about the lack of funding or the unreliability of the funding from national governments. There was also interesting conversation across the mayors about their re-election concerns, right? And even if you want to claim as a mayor you're not so interested by the re-election, you really want to focus about the good of your people, there was a concern that what is your opposition doing? And if you're an innovator, is your opposition just using this to point out you're not doing what everybody else is doing? But really the loudest message, I thought, and most interesting one, was the need for education in the relationship between the private sector and the public sector, and the timing of this relationship and the nature of this relationship. And really, I think, to me, this is one of the key message of this crisis, and what gives me hope is that, and us economists in academia, we contributed in the wrong way to this thing by pretending that through optimal contracts and incentive schemes we could reproduce what proper values and shared vision could deliver, right? Really, what we heard about is moving beyond these financial carrots and sticks. If anything, maybe the crisis, maybe that's oversimplifying, but the crisis has cleaned up the sectors. There are much less of us here at MIPIM than there were in 2007, but the ones who left, they seem to be very passionate about real estate and very passionate about developing a proper urban environment. And so this is, you know, moving toward new financial regulations and relationships. This is moving towards new processes for interactions. The mayor of Dortmund was explaining how their process is so fast. They caught the private sector off guard by being ready before the plans were ready for expansions. You know, and really that proper leadership is about developing shared visions and fostering synergies to take advantage of our diversities. And I think really it's about, as a city, or what you heard the mayor say, it's about moving from being a referee between the developer and the local community that gets angry about any new project that's going to disrupt the space. Moving from this referee position to a proper leader who organizes the conversation between the private sectors and the local community to build on diversity of opinion to really get something that will be attractive and that will make life for all of us a much more interesting life. And so that's why I think that what we get out of this is, going forward, a change in the way we engage each other in the conversation that leads to the built environment within which we all live. And so really, we talked about last year the sun rising, we talked about maybe some concern, it was burning a bit too hot on some market, maybe coming down. What I think, what I view as key lessons from this crisis, is that when we are today, is a triumph of the city. It's just a bright new day coming forward for the cities going forward. With this, I want to thank you for participating and listening to us. We do have a bit of time for questions, and I believe that there are some microphones. And the only thing I would ask with the questions, the microphone is right here, is you raise your hand and tell us your name, your firm, and restrict your questions to one sentence, please. Anybody? Yes? Thank you.
Leoman, I'm active in Brazil, but I'm just curious, how does the Sao Paulo auction work? I didn't quite understand what you're saying with respect to densities.
So it's... and I will give you at the end the business card of the man who runs the process in Brazil, so you can ask him the very detail. But what I like about the scheme is that at the time when the government, so what's very important is that the government has a legal way to commit to new construction in advance. And it has a legal way to commit to a certain amount of infrastructure investment. And so that the private market can understand what is really going to be available as a development opportunity. But then instead of, in some countries, what would happen is we commit to this, and then whoever happened to own the land at the time in the place, it's just a jackpot winner. And so they don't do that. They say, now that we are going to allow this increased construction, if you want to build in this area, you need to buy the permit from us. And that permit, we are going to sell it to you at an auction. And that's a textbook way to... And then they use that money, so then they get funding, and then they can use that money to fund the infrastructure. So in Copenhagen, what they told us is that they don't do an auction system, but they have a bargaining process. But what's very important is that the outcome of the bargaining process is public. And that, again, transparency, you know, bringing benefits. And that's why I think it brings a big difference in where the money is going to be made from development. But I can tell you there were mayors from Canada who were explaining to us because of constitutional restrictions, they couldn't move to such mechanism, and so they were trying to find ways to get around, to which the Brazilians answered, and the Danish answered, well, we changed the laws we needed to change to get this done. So I think it's very exciting times. Well, I don't know, it depends which side, where you sit. It depends where you sit, yes. Yeah, Jean-Claude? Hold on for the microphone, please.
Jean-Claude Goldenstein, Career Point. What's your biggest surprise?
So it's a very interesting exercise for us and for my students. We get here and we've learned from experience not come here with preconceived views, because we get fooled all the time and whatever we prepare is useless, we throw it away. I did not expect that I would stand here and tell you that transparency had gained such power or was become such a big issue for everyone. And you know, I knew about transparency in the private sector because that was there last year. But it was very clear talking to the public sector. Transparency and you know, not to be cynical, I mean, it's the markets are pushing this. It's just lack of resources. It's become too costly to leave opportunities on the table. And people are becoming more transparent and trying to find ways to work together. And I was not expecting, I expected a message to be a lot more about the markets, like about, you know, we're very concerned about the risk and maybe down with what's happening in the turmoil we have in North Africa and the Middle East. And I find that there was a lot of enthusiasm coming from this regeneration of the city, the urban way of life has won. So that, and maybe the second one would be the obsolescence. I think obsolescence is going to hit us faster than we think. And the reason I see that is I see some developers I know have been successful for years who are just moving ahead, taking advantage of that. In London, some of you might know better than me, there is a whole bunching of leases that over the next 2 or 3 years are going to expire in the office market. And it's very clear that those tenants are not going to stay in the old buildings where they are. And I think it's going to be fascinating to see what happens. I think another bifurcation, but one that is sustainable because of just different appreciation for the type of products. Any more questions? The counter here is flashing red, so it remains for me to thank you, to invite you to a cocktail outside, and if we don't see you at MIPIM Asia in November, then I hope we'll see you again next year here in Cannes. So thank you very much.